Welcome back to the Deep Dive. Today we're tackling the latest numbers from ICICI Lombard General Insurance, ICICI. We've got their Q2 and half-year results for FY26 here.
And our job really is to cut through some, let's say, significant noise in these reports. It's not straightforward this time.
Not at all, because if you just, glance at the main revenue number, the gross direct premium income, or GDPI, you'd probably raise an eyebrow.
You definitely would. It shows degrowth.
Right, down 1.9% in Q2 and down about 0.5% for the first half of the financial year.
Well, the rest of the industry is actually growing, right? About 6% and 7% respectively. So it looks bad on the surface.
Exactly. Looks like a major miss. But, and this is the crucial but, it's almost entirely down to an accounting change.
Yes, this is absolutely central. You have to understand this before looking at anything else. It's the IRDAI's one accounting rule change for long-term products. That kicked in October 1st, 2024.
Okay, let's break that one rule down right away, because like you said, it changes how we read everything. What exactly is it doing?
Think about selling, say, a 3-year car insurance policy, the old way. You collect all 3 years premium up front, maybe it's 3,000 rupees.
And book it all as revenue in year one.
Correct. All 3,000 rupees hit the revenue line straight away. The new one rule says, no, you can't do that, and is the policy length in years.
So 3 years in this case.
Right. So you take the 3,000 rupees, divide by 3, and you can only book 1,000 rupees as revenue in year 1, then 1,000 in year 2, and 1,000 in year 3.
Okay. So the cash flow hasn't changed. They still get the money up front.
Exactly. Cash is in. But the revenue recognition is spread out. It's, arguably a more conservative way to account for it.
But it makes comparing this year to last year almost impossible on that top line.
Completely impossible. That's why the headline GDPI looks negative. But analysts have done the math if you strip out that accounting effect.
What does the real growth look like?
Well, for H1 FY26, the underlying GDPI growth was actually positive 4.2%.
Okay, 4.2%. Still lagging the industry a bit, but definitely not shrinking.
Right. And if you go a step further and take out the crop and mass health segments, which they're intentionally managing down or being very selective about.
Because they can be volatile or less profitable.
Precisely. Then the core GDPI growth for H1 was 3.5%. Again, not setting the world on fire, but it shows discipline, not decline. They're choosing profitability over just chasing premium.
That makes so much more sense. And it fits perfectly with the bottom line, the profit numbers, which look frankly fantastic.
Yeah, the profit story is the complete opposite of that initial GDPI confusion. Profit after tax, PAT.
Up 18.1% year on year in Q2. That's 8.2 billion rupees.
And for the full half year, H1 PAT was up nearly 23%, hitting almost 15.7 billion.
Huge growth. Profit before tax, PBT, showing similar strength too.
Yep, up 22.3% for the half year. And a decent chunk of this comes from their investments performing well. Net capital gains were up compared to last year.
So 6.16 billion in H1 this year versus about 5.2 billion last year.
Yeah.
That certainly helps cushion things.
It definitely helps support the bottom line, especially if underwriting conditions get a bit tougher.
Okay, so the profit is strong. The headline revenue is misleading because of accounting. But what about the core insurance business profitability? The combined ratio, the crore. That tells us if they're making money on the policies themselves, right?
Exactly. And here, things look a little less rosy at first glance. Remember, over 100% means you're paying out more in claims and costs than you're earning in premiums for that period.
On the number.
It was 105.1% in Q2 and 104.0% for the first half, H1.
So both slightly worse than last year. 104% for H1 compared to 103.2% last year?
Correct. So on the surface, a slight deterioration in underwriting profitability.
Why would that be, if they're being so disciplined on the top line?
Well, there's another factor we need to account for. Catastrophe losses, CCAT losses, think floods, major storms, that kind of thing.
Unpredictable events. How much impact did they have?
About 0.73 billion rupees in this H1 period. If you take those out to see the kind of underlying operational performance.
What does the core look like then?
For Q2, the ex-CAT core drops to 103.8%. Still a bit higher than last year's ex-CAT number, mind you, which was around 102.6%. So some underlying pressure maybe.
103.8%.
Yeah.
Still feels a bit high if you want pure underwriting profit.
It does in isolation. But context is everything here. You have to compare it to the rest of the industry. Management made a point about this.
What did they say?
They said their combined ratio, even calculated on the new 0.9 basis accounting, was 102.9% back in Q1. And crucially, that was over 12 percentage points better than the industry average, which which was struggling up around 115%.
Wow, 12 points better. That's a massive gap.
It really is. It shows that even if their core isn't below 100%, they're operating way more efficiently and profitably from an underwriting perspective than their competitors. That's a significant competitive advantage.
Okay, that context is vital. So strong profits, superior relative underwriting. What about financial stability? Solvency,
Rock solid. The solvency ratio was 2.73 times as of September 30th.
which is up slightly from March and way, way above the minimum 1.5x required by the regulator.
Loads of cushion. It gives them flexibility, the power to take on good risks, and that strength flows through to shareholders.
How so?
Well, return on average equity, ROAE, climbed nicely to 20.8% for the half year.
Up from 20.3% last year. Healthy.
Very healthy. And they backed it up with action. The board declared a higher interim dividend, 6 rupees 50 paise per share.
Up from 5.50 last year. So, strong profits, check. Excellent solvency, check. Good returns to shareholders, check. Very solid financial foundation.
Absolutely. It sets the stage for looking at where they're actually focusing their efforts strategically within the different business lines.
Right, let's pivot to the segments, because there's been some major external shifts here, particularly from the government, that are changing the game.
Oh, massively. The changes around GST, the goods and services tax, are huge. Management literally called it the biggest marketing boost the sector has ever received.
Okay, explain that. What specific GST changes are we talking about?
Two main things. First, they removed GST entirely from individual health insurance premiums.
Makes health cover cheaper overnight for regular people.
Exactly. Big affordability boost. Second, they rationalized GST rates in the auto sector, which basically lowers the cost of buying and owning a vehicle.
Also positive for insurance demand. Any idea of the scale of this stimulus?
The estimates are pretty staggering, somewhere between 2,200 to 3,100 billion rupees injected into the economy collectively from these changes.
Wow. Okay, that's a serious tailwind. How is that playing out in their motor segment? That's usually their biggest piece of business.
Motor GDPI growth for the whole first half was only 2.2%, which sounds weak again.
Yeah, given that GST boost.
The impact really started to bite towards the end of the period. In September alone, their motor segment grew 6.5%.
Okay, so it's kicking in now.
Seems like it. And their new private car business specifically grew almost 18% in September. The industry only grew about 5.8% for private cars that month.
So they seem to be capturing a good share of that initial GST-driven recovery.
It looks that way. And they're also being smart about which motor business they write. They're shifting the mix.
How so?
More private car business, that share went up to over 54%. Less commercial vehicle business, that share dropped below 20%.
Focusing on the generally more profitable, less volatile private car segment. Makes sense. What about the claim side for motor, the loss ratio?
The own damage loss ratio did tick up a bit to 68.5% for the half year.
Higher than last year's 65.2%. Is that a concern?
Management seemed comfortable. They said the overall motor loss ratio for H1 was still within their target range of 65% to 67%. So they seem to have it under control despite the slight rise.
Okay, manage risk there. Now, retail health. This must be where that GST exemption on premiums really hits home.
Oh, absolutely. This is the standout growth story. Their retail health indemnity business, the core health insurance product, grew by 25.2% in H1.
25%?
Yeah.
How does that compare to the industry?
It blows it away. The industry only grew 9.3% in that segment.
So they're growing nearly 3 times faster than the market in retail health.
Yes. And it shows in market share. They went from 3.2% share in H1 last year to 3.7% this year. And get this, in September, they crossed 4% market share in retail health indemnity for the very first time.
That's impressive momentum. But the immediate question with growth that fast is, are they buying market share? Are they sacrificing price discipline? What's the loss ratio look like?
That's the crucial check. And the numbers say no, they're not sacrificing discipline. The retail indemnity loss ratio was 69.7% for H1.
Okay. And their target range?
Their target is 65% to 70%. So it's right at the upper end, but smack bang within their target.
So market-leading growth and maintained profitability. That's the sweet spot.
Exactly. That's sustainable growth.
Yep.
And quickly on the commercial side, it wasn't forgotten. They saw good growth there, too. Fire insurance, for instance, up 27% in Q2.
And they're still leaders in complex areas like engineering, marine cargo, liability.
Yep, holding on to leadership there. It shows their underwriting skill isn't just limited to the consumer lines. They can handle the complex stuff profitably, too.
Okay, so pulling it all together, the financials show smart management, superior underwriting relative to peers, strong profits despite the noise. But you often say the real long-term advantage, the moat, comes from something else.
It does. It comes from technology and customer experience. That's what locks customers in and drives efficiency. And the metrics here are quite something.
Let's hear them. Claim speed. That's the moment of truth for customers.
You bet it is. In H1, ICICI Lombard paid 99.6% of all their retail health claims within 30 days.
99.6%?
Yeah.
That's almost perfect.
It's incredibly high. And for motor-owned damage claims, it was 96.4% paid within 30 days.
How does that stack up? Do we have an industry comparison?
We do for motor. The industry benchmark for Q1 was only 82.4% paid within 30 days.
So 82% versus their 96%. That is a massive difference in customer experience.
It's night and day. And that speed is why customers seem happy. Their net promoter scores, NPS, really strong. 72 for health claims, 66 for motor claims.
Happy customers stick around.
Mm-hmm.
And they probably tell their friends.
Exactly. Lower churn, lower acquisition costs. It feeds directly into profitability. Plus, their tech adoption is huge. The I'll Take Care app has over 18.4 million downloads.
And they're using tech and service for specific customer groups too, right?
Yeah, I thought this was interesting. In June, they launched special service desks just for senior citizens and for customers who hold multiple policies with them, high product density customers.
Tailored service for valuable segments. Did it work?
Apparently, yes. They said those desks generated over 3,000 cross-sell opportunities in just a few months. It's smart, targeted relationship building.
It all paints a picture of a company that's not just managing risk well, but really focusing on operational excellence and the customer. Oh, and one more thing, ESG.
Right. Important for many investors now. Their MSCI ESG rating got a big upgrade in August, from A all the way up to AAA.
The highest possible rating.
Okay.
So ticking the boxes on governance and sustainability too.
It really rounds out the picture. Strong financials, operational leadership, customer focus, and solid ESG credentials.
So let's try and summarize the key takeaway for you, the listener. Despite some really confusing headline numbers, because of that one accounting rule.
And taking a hit from some catastrophe losses.
ICICI Lombard actually delivered really strong performance where it matters most. Profits surged, their capital cushion is huge, and they showed impressive operational grip.
Especially in grabbing profitable market share in retail health, helped along by those big GST changes. And that motor segment seems to be picking up steam again, too.
It really feels like their focus on efficiency and customer service. You know, that incredible 99.6% health claim payment speed is paying off.
Which leads us to a final thought for you to chew on. We've seen they can settle claims way faster and keep customers happier than competitors. In a market that's about to get even more competitive, potentially flooded with demand thanks to things like the GST changes, is this proven operational excellence their ultimate weapon? Does this ability to deliver a better experience guarantee they can maintain that superior combined ratio and keep growing profitably in the long run, even as everyone else tries to catch up? It's something to definitely think about. That's all we have time for on this deep dive. Thanks for joining us.
We'll catch you next time.